Now let's shift our focus to the futures market and welcome in Chris Robinson. He's Managing Director of TJM Institutional Services. Chris, thank you so much for joining us here. Let's start off with oil and specifically the natural gas stocks. They're trending a little bit lower today following a mild March when it comes to weather. Tell me what you see going on.
Well, natural gas has had an unprecedented collapse, really, from those highs. We were at, $10 level down to just 2 weeks ago. We hit 2.5-year lows, right around the $2 even level. A lot of people stepped in there and bought that. We just bounced up to 3. Now we dropped back sharply. People are trying to call a bottom in natural gas. We did have a very mild winter, and so I think anybody, especially 3-4 months ago, people were all got long anticipating continued problems, obviously, with what's going on in the Ukraine. But, luckily, Western Europe dodged a bullet because they did not have an extremely cold winter, so they didn't need to, have it use as much fuel. So you had that drop in demand, and I think it caught a lot of speculators off guard, too, because heading into Christmas, that was the trade du jour. Everybody wanted to be long natural gas. And this just shows you what happens when the market has different ideas than speculators. You're
absolutely right. I mean, here in Chicago, it's been an unusually mild winter. We'd have had about 2 snowstorms by now, right?
I know. I was outside today. It's 50 degrees. It's beautiful.
Right. It's beautiful. The sun is shining. So let's switch gears over to bonds. Now, there's a lot of talk, or specifically an article in the Wall Street Journal talking about where people are looking, how some investors are considering more discounts or wanting more discounts on corporate bonds, while others are looking more to government bonds. Where are you seeing more activity?
Well, there's nothing like a riskless rate of return, right? And you can't get any more riskless than a 2-year note or a 1-year note or a 3-month T-bill, going all the way out. We've seen that when you have the 10-year yielding right around 4% and the 2-year yielding right around 5%, that will pull away some people that do not want to be exposed to risk. So you're going to see probably more funds move away from that. For 12 years, 14 years, really since the great financial crisis since '08, bonds haven't really been a choice. People were forced to go into the stock market to get yield. Of course, we've all been taught that, the historical rate of return, if you own stocks over a long period of time, is somewhere between 8 and 12%, depending on what figures you use, but 8 to 12%. If you can get 5% riskless for a couple of years, people are going to be like, maybe I don't need exposure to the daily whipsaws. And we've had a lot of whipsaws in the stocks in the past 2 years. So I think that's the key to watch. When people can take a riskless rate of return, they're going to stop and take a look at that. And we haven't had that opportunity. Really, it started happening about 3, 4, 5 months ago as the Fed started raising rates.
Let's talk briefly in the last minute we have about the U.S. dollar index. It is lower today. We have Fed Chair Jerome Powell talking this week to Congress. What are you expecting as far as moves for the dollar?
Well, the dollar's had a big correction off its, we were at 20-year highs just a few months ago, 114.75. We broke down to the 101 level, almost the par level. We bounced back up here. A lot of people are anticipating possibly going back to, if rates continue to go higher, that won't make people want to own the dollar again. That's higher rates will be higher for the dollar. So that's the sort of the seesaw effect. Now you've seen the dollar ebb and flow. Not that long ago, people were talking about maybe we're going to have a soft landing, maybe there's going to be a no landing. But I would say that's going to be key. The dollar is going to be very, very sensitive to what the perceptions are. And if Chair Powell sticks to his guns like he has been, it looks like rates are going to be higher for longer. If that's true, that should be supportive for the U.S. dollar. So, we may have put a bottom end here from right now. So I would watch that carefully, that 101 level, 100 level on the dollar.
Absolutely. It'll depend on us getting a hawk or a dove out of Powell. Thank you so much, Chris Robinson, who is the Managing Director of TJM Institutional Services.